Welcome, everyone. Today we are going to dive deep into volume indicators used in technical analysis. These are tools that can really help you understand how strong price movements are and what they say about the mood of the market. By the end of this talk, you will know how to use key volume indicators to make better trading decisions and understand the markets more clearly. Are you ready? Let's get started. Before we dive into the details, let me ask you a question. Have you ever wondered how traders gauge the strength behind price movements? It is not just about what direction the price is heading, but about understanding the conviction behind that movement. This is where volume indicators come into play. Volume indicators show how much trading activity is happening. They tell us how many shares or contracts are being bought or sold in a given time. Why is this important? Because the volume of trades gives us insight into the sentiment of the market. When a price moves up or down with high volume, it often means that the movement is stronger and more likely to continue. But if the price moves with low volume, it can mean that the move is weak and there may be indecision among traders. In addition to volume indicators, it is also important to understand chart patterns, which can provide more context to the strength or weakness behind price movements. Chart patterns are visual formations on a price chart that can indicate future price movements. Some of the most commonly used chart patterns include head and shoulders, double tops and bottoms, triangles, and flags. Each of these patterns can give traders clues about potential trend reversals or continuations. The head and shoulders pattern, for example, is a reversal pattern that signals a change in trend direction. It consists of 3 peaks, with the middle peak being the highest. When the price breaks below the neckline, which is a support level connecting the low points of the pattern, it indicates that the uptrend is likely ending and a downtrend may be starting. Conversely, an inverse head and shoulders pattern can signal the beginning of an uptrend. Double tops and bottoms are also reversal patterns. A double top occurs when the price reaches a high point twice, with a pullback in between, suggesting that the uptrend is losing momentum and a reversal might occur. A double bottom is the opposite, where the price reaches a low point twice and signals a potential upward reversal. Triangles are continuation patterns that indicate a period of consolidation before the price moves in the direction of the existing trend. There are 3 types of triangles: ascending, descending, and symmetrical. Ascending triangles have a flat resistance line with rising support, often signaling a bullish continuation. Descending triangles have a flat support line with falling resistance, typically signaling a bearish continuation. Symmetrical triangles have converging trend lines and can signal a breakout in either direction, depending on where the price moves. Flags are short-term continuation patterns that form after a sharp price movement called the flagpole. The price then consolidates within a small, rectangular range, which forms the flag. When the price breaks out of this consolidation range, it often continues in the direction of the initial move, resuming the trend. Understanding these chart patterns, along with volume indicators, provides a more complete picture of market sentiment. For instance, if a head and shoulders pattern forms along with declining volume, it can confirm the likelihood of a trend reversal. Similarly, when a price breaks out of a triangle pattern with increasing volume, it adds strength to the breakout signal. By combining chart patterns and volume analysis, you can make more informed trading decisions and better anticipate potential market movements. So, what are some key volume indicators we can use? The first one we will talk about is called on-balance volume. On-balance volume adds the trading volume on days when the price goes up and subtracts it on days when the price goes down. It is a cumulative tool, which means it builds on itself. If the on-balance volume is going up, it is telling us that more people are buying and that an uptrend is likely strong. If it is going down, it tells us that a downtrend may be in play. On-balance volume is a good way to confirm what is really happening in the trend. Are you following along? Great, because we are just getting warmed up. Now, let us talk about another important tool, the volume oscillator. The volume oscillator compares a short-term moving average of volume with a long-term moving average. If you see a positive reading, it means that volume is increasing and there is stronger market momentum. If you see a negative reading, it means that volume is decreasing and the momentum is fading. Understanding this indicator can help you recognize whether the strength of a trend is growing or shrinking. Let us expand on chart patterns a bit more, as they are crucial in understanding potential future price movements. One of the most well-known continuation patterns is the cup and handle pattern. This pattern resembles the shape of a teacup with a rounded bottom followed by a smaller consolidation that forms the handle. A breakout from the handle often signals a continuation of the uptrend. The key to validating this pattern is observing a steady increase in volume during the breakout, indicating strong buying interest. Another important chart pattern to recognize is the wedge pattern, which comes in two forms, rising wedges and falling wedges. A rising wedge is often a bearish pattern that forms during an uptrend and suggests a potential reversal. As price makes higher highs and higher lows within a converging trend line, decreasing volume typically signals weakening bullish momentum. A breakdown from the wedge with increasing volume confirms the bearish reversal. On the other hand, a falling wedge is typically a bullish pattern that forms during a downtrend and can signal a potential reversal to the upside, especially when accompanied by increasing volume. It is also important to consider the broader market context when trading wedge patterns. For instance, rising wedges that form during periods of overall market weakness can often be more reliable indicators of an upcoming bearish reversal. Additionally, watching for divergences between price and momentum indicators like the relative strength index or the moving average convergence divergence (MACD) can provide further clues about the validity of the pattern. If a rising wedge forms alongside negative divergence, where the indicator fails to make new highs while price does, this can be a powerful signal that the upward trend is running out of steam. Similarly, falling wedges are most effective when they form during broader market downtrends that appear to be losing strength. Positive divergence between price and momentum indicators, where price makes new lows but the indicator does not, can strengthen the case for a bullish reversal. When evaluating a falling wedge, it is crucial to observe the volume behavior as well. Ideally, volume should contract during the formation of the wedge and then expand on the breakout, indicating a surge in buying interest as the downtrend reverses. Wedge patterns are often more reliable when they align with key support or resistance zones. For example, if a rising wedge forms near a major resistance level, the likelihood of a bearish reversal increases. Conversely, if a falling wedge forms near a strong support level, the chances of a bullish reversal become more significant. Understanding where these patterns appear in relation to major market levels can help you assess their effectiveness. Also, keep in mind that wedges can form in multiple time frames, and their significance can vary accordingly. A rising wedge on a daily chart may signal a longer-term trend change, whereas one on a smaller time frame, like an hourly chart, may indicate only a short-term correction. Always consider the time frame in relation to your trading strategy and ensure that the pattern fits the context of your broader analysis. Rectangles, also known as trading ranges or consolidation zones, are another type of chart pattern where the price moves sideways between parallel support and resistance levels. When the price finally breaks out of the rectangle, either upwards or downwards, the volume plays a key role in determining the strength of the breakout. Strong volume supports a genuine breakout, whereas weak volume may indicate a false breakout or a continuation of the consolidation phase. Another classic chart pattern is the pennant, which is similar to the flag pattern but has converging trend lines that create a small symmetrical triangle. Pennants are short-term continuation patterns that occur after a strong price movement known as the flagpole. The breakout direction from the pennant generally follows the original trend, and increased volume during the breakout adds strength to the movement. Rounding bottoms, also known as saucer bottoms, are long-term reversal patterns that indicate a gradual shift from a bearish trend to a bullish trend. The price forms a rounded bottom, and a breakout above the resistance level confirms the reversal. This pattern is often accompanied by a gradual increase in volume as the price moves higher, signaling growing buying interest and a strengthening trend. Broadening formations, also called megaphone patterns, occur when price action forms higher highs and lower lows, creating an expanding shape. These patterns can be tricky to trade due to their unpredictable nature, but strong volume at the extremes of the formation can signal potential reversals. For example, if price reaches a new high within the broadening formation with a significant increase in volume, it could indicate exhaustion followed by a reversal. By thoroughly understanding these chart patterns and combining them with volume analysis, you will be able to gain deeper insight into potential price movements. Watching how volume behaves at key points within these patterns can help you determine whether a breakout or reversal is genuine, thus giving you greater confidence in your trading decisions. Another great volume indicator to understand is the accumulation distribution line. This one measures the flow of money into or out of a stock. It does this by comparing price movements and volume. If the accumulation distribution line is rising, it means that money is flowing into the stock, which is called accumulation. If the line is falling, it means money is flowing out, which is called distribution. This helps you see whether a stock is being accumulated by buyers or distributed by sellers. So, how can you use volume indicators to confirm a trend? Think about it like this. When the price goes up and volume also rises, it confirms that the buyers are in control. This tells us that the uptrend is likely strong. On balance volume, the accumulation distribution line and the volume oscillator are all tools you can use to see if volume is supporting the trend. In a downtrend, when volume goes up as price falls, it means that sellers are in control and the downtrend is likely strong too. It is also important to watch out for divergence. If the price is going up but the volume is falling, it may mean that the trend is weakening and could reverse soon. Volume indicators are also useful for spotting reversals. A reversal is when a trend changes direction. One thing to watch for is a spike in volume near key support or resistance levels. For example, if the price hits a key level and there is a big jump in volume, it could mean that the price is about to reverse direction. Another signal is divergence between price and volume. If the price keeps rising but the volume starts to decrease, it can be a sign that the trend is losing steam and could reverse soon. Are you starting to see how powerful volume can be when it comes to understanding what is happening in the market? Another important area where volume comes into play is breakouts. A breakout happens when the price moves above a resistance level or below a support level. For a breakout to be real, you want to see strong volume. When there is a lot of volume during a breakout, it means that there are many participants behind the move, which makes it more likely that the breakout will continue. On the other hand, if there is low volume during a breakout, it can be a warning sign that the breakout may be false and that the price could fall back into the previous range. So always make sure to check the volume when you see a breakout. There are different types of breakout patterns that traders watch for, each with its own characteristics. One common breakout pattern is the ascending triangle. In an ascending triangle, the price creates higher lows while facing a consistent resistance level. When the price finally breaks above this resistance, strong volume can confirm the breakout, suggesting a continuation of the uptrend. If volume is lacking, however, it may signal a false breakout and price could retrace. Another key breakout pattern is the descending triangle. This is essentially the opposite of an ascending triangle, where the price creates lower highs and tests a consistent support level. When the price breaks below this support with high volume, it confirms the bearish breakout and indicates that further downside is likely. Again, volume is crucial here, as low volume may indicate the breakdown is not reliable. Symmetrical triangles can also lead to breakouts in either direction. In this pattern, the price creates both lower highs and higher lows, converging towards a point. A breakout in either direction, supported by strong volume, can indicate the beginning of a new trend. Traders should be cautious of low volume breakouts, as they may lack the strength needed to sustain the movement. Another type of breakout occurs with the rectangle pattern. A rectangle is formed when the price moves sideways between well-defined levels of support and resistance. When the price breaks out of this trading range, either upwards or downwards, traders look for strong volume to validate the move. A high volume breakout suggests that the market has chosen a direction decisively, while a low volume breakout might indicate a continuation of the prior consolidation or even a reversal back into the range. Breakouts can also be found in the context of flag and pennant patterns. After a sharp price movement forms the flagpole, the price consolidates within a flag or pennant. A breakout from this consolidation range with strong volume typically signals a continuation in the direction of the original movement. The stronger the volume, the more likely it is that the breakout will sustain itself. One more breakout pattern to watch for is the cup and handle. In this pattern, the cup forms a rounded bottom, followed by a smaller consolidation that creates the handle. A breakout from the handle with increasing volume indicates that the uptrend is likely to continue. This pattern is particularly powerful when validated with strong volume, as it shows broad buying interest. Recognizing these breakout patterns and understanding how volume interacts with them is key to confirming whether a breakout is genuine or false. High volume means more market participants are committed to the direction of the breakout, making it more likely to succeed. Always remember, low volume breakouts are risky and may lack the strength to follow through, often leading to reversals. By using both chart patterns and volume analysis, you can improve your chances of identifying successful breakouts and avoid falling for false signals. Let us also talk about volume indicators that can help you identify trend reversals and shifts in momentum. One such tool is the Money Flow Index. The Money Flow Index is like a volume-weighted version of the Relative Strength Index. It helps measure buying or selling pressure based on both price and volume. This makes it useful for spotting overbought or oversold conditions. Another tool is the check-in money flow. The check-in money flow looks at whether money is flowing into or out of a stock. If the check-in money flow is positive, it means there is buying pressure. If it is negative, it means there is selling pressure. You can use this to confirm price trends and spot when a trend may be ready to reverse. Now that we know about these indicators, how can we put them to use in practical trading strategies? Well, first you can use unbalanced volume or the accumulation distribution line to confirm a trend. If you see the price rising and volume rising as well, that is a good sign to enter a long trade. If the price is dropping and the volume is also increasing, that could be a signal to enter a short trade. For breakout trading, you want to look for a breakout with rising volume to confirm that it is likely to continue. And when it comes to reversals, look for divergence between price and volume at key levels. If you see that volume is not supporting the trend, it could be a sign to enter a trade in the opposite direction. Combining volume indicators with other tools can also make your trading strategy stronger. For example, you can combine volume with moving averages to get a clearer picture of the trend. If the price is above the moving average and volume is also increasing, it is a good sign that the trend will likely continue. You can also use moving averages in combination with chart patterns such as triangles or flags to confirm potential breakouts. If a breakout from a chart pattern coincides with increasing volume and the price moving above a key moving average, it gives added confidence in the continuation of the trend. Another idea is to combine volume with the relative strength index to confirm overbought or oversold conditions. If the relative strength index shows that a stock is overbought and you also see that volume is falling, it could mean that the price is about to reverse. Conversely, if the relative strength index indicates that a stock is oversold and there is an increase in volume, it could be an early signal of a potential reversal to the upside. You can also use volume with Fibonacci retracement levels to see if a retracement is supported by strong market activity. For instance, if price retraces to a key Fibonacci level and volume starts to rise again, it can be an indication that the retracement is over and the original trend is likely to resume. Furthermore, combining Fibonacci levels with volume spikes at these key areas can help you better identify the strength of buying or selling pressure, making it easier to decide whether to enter a trade or wait for further confirmation. Let us touch on risk management for a moment. When you are trading with volume, you can place your stop loss just beyond key volume spikes or areas with high volume. This helps protect your trade in case the price reverses suddenly. You can also adjust your position size based on volume strength. When volume is high, it suggests strong market participation, so you can take a larger position. When volume is low, it might be better to reduce your position size to manage risk. Of course, there are some common mistakes that traders make when using volume indicators. One mistake is ignoring volume when the price is making a significant move. Remember, a price move without strong volume might not be reliable and could reverse. Another mistake is overreacting to small volume spikes. Not every spike in volume means a major market move is coming. It is important to look for confirmation from price action or other indicators before making a trade. And lastly, do not rely only on volume. It is a powerful tool, but it works best when combined with other indicators like moving averages, trend lines, or the relative strength index. To sum it all up, Volume indicators are powerful tools that help traders confirm trends, spot potential reversals, and validate breakouts. Tools like on balance volume, the accumulation distribution line, and check-in money flow provide key insights into market strength and momentum. Start by adding volume analysis to your trading strategy and pay attention to how volume aligns with price action. This will help you confirm trades and avoid false signals. Volume indicators are essential for any trader who wants to understand what is happening behind the scenes in the market. The more you practice using volume analysis, the better you will become at recognizing the strength behind price movements. If you have questions or thoughts, do not hesitate to share them and keep learning as you go.